On April 21, 2026, the ceasefire between the United States and Iran officially expires. The immediate consequence is a compromised Strait of Hormuz. With commercial transit halted, the global energy supply chain registers an acute physical shock. The primary market reaction is instantaneous. Brent crude spikes to $95 per barrel. A sudden energy shock of this magnitude typically triggers widespread equity sell-offs, but that does not happen here. Despite rising inflation metrics, India's Nifty 50 index actually closes the day in the green, and the U.S. Federal Reserve signals zero intention of initiating a panic rate hike. To understand how global markets price in exogenous tail risks, we will track the transmission of this specific geopolitical shock across three distinct asset domains: currencies, central banks, and emerging markets. Institutional capital does not react to news headlines. It relies on mathematical transmission mechanisms. The first measurable impact lands in the currency markets. When supply chains fail in the Middle East, the immediate reflex of institutional portfolios is to pull capital out of peripheral assets and move it into highly liquid safe havens. This line chart tracks the result of that flight to liquidity. The US dollar index, or DXY, climbs 0.24% to hit a one-week high of 98.3. As global risk appetite drops, dollar strength rises. For emerging economies, this creates a compounding penalty. They are forced to pay for $95 oil using a severely depreciated local currency against that stronger dollar. That elevated cost of imported crude bleeds directly into their domestic economies, stoking fears of a second, broader wave of global inflation. The strength of the DXY confirms the market has diagnosed a severe risk-off environment. This shifts the pressure directly onto the Federal Reserve. We turn to the monetary policy response. Headline: U.S. Consumer Price Index data has just spiked 0.9% month over month. That is the sharpest jump recorded since 2022, driven almost entirely by the rising cost of gasoline. This spike in consumer costs presents an immediate test for the incoming leadership of the central bank, specifically Kevin Warsh, the nominee for Fed chair. Analysts at J.P. Morgan Global Research point out that the Fed is treating the Strait of Hormuz closure strictly as an exogenous supply shock, rather than structural, demand-driven inflation. Next to the alarming 0.9% jump in headline CPI sits the core CPI measurement. Stripping out volatile energy prices, core CPI increased by just 0.2%. The gap is the energy delta. The Fed isolates this noise, focusing solely on the core number for policy adjustments. The second pillar supporting the Fed's stance is domestic employment. The U.S. labor market remains highly robust, adding 178,000 payrolls while unemployment sits at 4.3%. Because core inflation is contained and employment is strong, the Fed holds the federal funds rate steady at a range of 3.5 to 3.75%. By refusing to hike rates, the Fed's patience acts as a critical shock absorber. It prevents the economy from suffering a devastating dual shock of soaring energy prices combined with rapidly tightening liquidity. With the Fed holding steady, we activate the final node, emerging markets. Moody's issued a severe warning that prolonged energy disruption in the Middle East will severely widen India's trade deficit and strain its fiscal accounts. Yet the Bombay Stock Exchange absorbed the shock with absolute resilience. The Sensex actually posted gains, reclaiming the 79,000 mark. This Univest probability matrix explains the mechanism. A 60% base case predicts a stable Nifty 50 range, actively backstopped by massive purchasing from domestic institutional investors. Conversely, a 15% downside risk only triggers if Brent crude breaches $105, impacting oil and aviation stocks. Emerging market equities survive external geopolitical shocks by relying on massive domestic liquidity floors, combined with strict algorithmic thresholds tied directly to commodity prices. Bringing all three asset classes back onto our node map, we see these pathways actively flowing. The global macroeconomic system is currently trapped in a highly calibrated, extremely fragile holding pattern. Stripping away the complexity isolates the single leading indicator that controls all three domains. If crude breaks above $105, the holding pattern fails. Core inflation becomes unanchored, the Fed must hike rates, and emerging market equities break support. And this is the mechanism of contagion. If diplomacy resumes and crude slides below $90, the shock dissipates. Capital flows unlock the 25% bull case scenario, and global equities advance. For macro analysts, the geopolitical noise and diplomatic posturing are secondary. Institutional capital will only follow the sustained price action of Brent crude as it tests the $96 threshold.